Hello and welcome to Unacademy and my special class on the Indian Partnership Act 1932, Part 2. I call it Part 2 because Part 1 was completed yesterday, and today will be the concluding part of the Indian Partnership Act 1932. Before I start, I would like to know if I'm visible and audible and if I'm clear. I would request the participants to give me a thumbs up if they can hear me and see me properly before I proceed. Hello, Sharvani. Hello, Ritija. How are you both doing? Hello, Chunky. Hello, Shiv. How are you? Good to see you again. All right, let's start my session today. Firstly, I welcome you to Unacademy, India's largest online learning platform. And this is a series started by Unacademy which says Crack CA exams with us. So, this particular series is for the CA Foundation and Intermediate course where I will be taking a lot of sessions on all relevant topics. A brief introduction about the educator today, that is me. Hello, I'm Prathik Gupta, a Bachelor of Commerce from Christ College, Bangalore University, an associate member of the Institute of Chartered Accountants of India, an associate member of the Institute of Company Secretaries of India, an associate member of the Institute of Cost Accountants of India, and also a law graduate from Karnataka State Law University. Currently in the practice of chartered accountancy and also a visiting faculty for CA subjects and tutor for CA students offline and online. Prior to starting my own practice, I was working with SR Bartley Boy and Co. That is an Indian member firm of Ernst & Young Global in the audit and assurance department. Post that, I worked with Ernst & Young in the mergers and acquisition department. After that, I had a stint in the industry. I joined the Manipal Group and was the corporate controller of their Indian entity and their entity in Germany. So that's a little brief introduction about me. Let's proceed. What does Unacademy offer you? Unacademy offers you daily live classes where you get to attend a class of your choice, of your relevance, and whatever you find important. You get a chance to chat daily with your favorite tutors and other people who are expert in that particular topic and matter. You have live quizzes and texts which enable you to evaluate your performance and your level of understanding and preparation and identify your weak areas and help improve on them. The Unacademy structure platform provides you structured courses so that your preparation is done step by step and no important aspect of your preparation is missed out. And lastly, but not the least, it gives you unlimited access to the various resources and content on the Unacademy platform, which you can access whenever you want. It's right at your fingertips and you can access the information whenever you feel like. So I once again welcome you to Unacademy, India's largest online learning platform. So for those who have not yet downloaded the Unacademy Learning app, I request you to download the Unacademy Learning app from your Play Store. It's a very simple procedure wherein you will download it and register yourself using your mobile number and an OTP. So if you've not done it already, I request you to please download the Unacademy Learning app from the Play Store and register yourself on it. And also spread the word around. Unacademy provides various subscription models for the various courses and resources that it has. For a CA Foundation and Intermediate subscription, Unacademy provides you the subscription for 1 month, 3 months, 6 months, 12 months, and 24 months, the rates for which are displayed on your screen. While you subscribe for the package of your choice, do not forget to use the code Prathik, Prathik, which will give you an additional discount of 10% on your subscription. So I look forward to seeing you around in Unacademy. So last class, we had taken up the Indian Partnership Act 1932 Part 1, which was conducted yesterday. Today is the continuing and the concluding part of the Indian Partnership Act 1932, and that's why it's called Part 2. So for the people who did not attend my session yesterday and are attending it today, I would like to give you a quick recap on what we missed yesterday. So yesterday we started off speaking about the Indian Partnership Act. The law of partnership is contained in the Indian Partnership Act 1932, which came into existence on 1st October 1932. A contract of partnership is a special contract where the Partnership Act is silent on any point. The general principles of the law of contract apply. This act applies to the whole of India except state of Jammu and Kashmir. Okay, now there was also a session on the Indian Contracts Act 1872 Part 1 and Part 2, which I took yesterday and day for yesterday. So what this slide simply means is The Partnership Act 1932 speaks about a lot of provisions relating to partnership. But if the Partnership Act 1932 is silent on any aspect of partnership, then it is covered by the Indian Contracts Act 1872. And as per the Partnership Act, there is a very special document known as the Partnership Deed, which is essential for any partnership to come into existence. A partnership deed contains all the provisions, rules, regulations, liabilities, responsibilities of the partnership and the partnership firm in relation to one another and in relation to the external uh, world. So, the most important document in a partnership firm is the partnership deed. Meaning and definition of partnership. Partnership is a relationship between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. So, in simple words, partnership is nothing else when two or more people come together to form a business or to form an organization to share the profits and losses of a business which is carried out by all or carried out by one on behalf of all. So all these relationships and responsibilities is contained in the document called as the partnership deed, which is of utmost importance. Thus, partnership is the name of a legal relationship between or among persons who have entered into a contract. It is the partnership deed is nothing else, or a partnership is nothing else but the official signing off on the document which creates a relationship between two or more people as partners who have agreed to come together to carry out a business in return for sharing of profits and loss of the business. I welcome Mrs. Beena Agarwal and Ms. Smriti Gupta. Thank you for joining in. Okay, now what is the nature of partnership? Just an introduction on what the partnership means. Now, please remember, I'm giving you a recap of what we have missed yesterday. So this will be covered quickly until we reach the content for the day. Okay, partnership is an association of two or more persons, results of an agreement between two or more persons. When two or more people come together to start a business, in return to share the profits or losses of the business, it is termed as partnership. And where do they capture the terms and conditions on which they work? They capture it in a document called the partnership deed. So the partnership deed contains all the essential requirements and provisions of the partnership. Agreement must be to share the profit of the business. So the agreement should clearly tell you that what profit ratio do partners share the profits of the business. If the partnership deed is silent about the profit sharing ratio, then it is assumed that all the partners equally share the profits and losses of the business. Business must be carried on by one or all of them. So let's assume there are two or three partners in a firm. So either all three of them can be actively involved in the partnership business, or one of them can carry the business on behalf of all of them. This again has to be authorized by the other partners or the partnership deed, through which the one person can carry on the business on behalf of everyone else. Unlimited liability, this is an important concept. I would like to take 2 minutes on this concept. The concept of unlimited liability simply means that the acts done by the partners on behalf of the firm, if there is any violation or any infringement, or in case there is any default carried on by the partners or the firm in paying any sums of money to someone else, then the person can actually sue the partnership firm and the partners, and the partners' personal assets that could include their car, their house, their bank balance, their FDs, that could be used to clear off the money to the sundry creditors. So the partners of a partnership firm need to be very careful as to being very committed and clear in repaying the amounts due to outside parties, or else their personal assets could be attached and taken away by the creditors on the order of the courts. Restriction on transfer of interest. The partners who have a 25, 30, 40, 50% profit sharing ratio cannot transfer their share or interest in the firm to another outside party without the consent of all the partners of the firm. If they do so, it would be unlawful and illegal and would actually end up in the closure of the partnership firm. Unanimity of consent, unless and otherwise the partnership deed speaks. So any decision in relation to the partnership firm should be taken by the unanimous consent of all the partners. By unanimous consent, I simply mean all the partners agreeing upon the same thing. In case they do that, then a particular decision is to be made. But if there are any provisions contained in the partnership deed which allow one or more partners to decide without the consent of the others, then that has to be followed. Agreement must be to carry on some business. like the Indian Contracts Act 1872 says that any agreement must have a lawful purpose, similarly, an agreement for partnership should have a lawful business as well. A partnership deed or a partnership firm cannot be created to carry any illegal or unlawful business. If it is done so, it will be a void agreement and no partnership will come into existence. I request you to take about 20 seconds, read the slide, and then we will proceed. Essentials of partnership. A partnership is an association of two or more persons. A partnership must emerge out of an agreement. The business so carried out must be legal and acceptable by law. The agreement must give all essential details of partnership, that is profit sharing percentage. Business to be conducted, minor cannot be a partner. While I have explained the first 3 points, I will talk about the fourth and fifth point. The agreement, the partnership deed, for whoever has got a chance to witness a partnership deed contains all the essential information and elements of the partnership. The information contained in a partnership deed is information like the date on which the partnership firm came into existence, the name of the partnership firm, the registered address of the partnership firm, the business the partnership firm is authorized to carry, the name and addresses of all the partners, the profit sharing and the loss sharing of all the partners, the capital contributed by each partner, and the rights, duties, and responsibility of each partner towards the other partners and the firm as a whole. So a partnership deed is a comprehensive document containing all the provisions relating to running of that partnership firm. Yes, Mr. Shiv, what's the question? Do you have a question? Okay. The last point, a minor cannot be a partner. Yes. If you again go back to my session on the Indian Contracts Act 1872, there are certain people who are barred from entering into a contract or disqualified from entering into a contract, and one of them is a minor. Minor is a person who has not reached the age of 18 yet. So a person who has not reached the age of 18 cannot be a partner in a partnership firm. He can definitely be admitted into the profits of the firm, but he cannot be a partner into the firm simply because he is incapable of contracting. So until he reaches the age of 18, he cannot enter into contracts, hence he cannot be a partner. Any questions? Please ask me. Okay, now what is the true test of partnership? Now, we might come across documents, we might come across things claiming to be partnership, but what is the true test of partnership? The true test of partnership is the existence of mutual agency relationship. That is the capacity of a partner to bind other partners by his actions done in the firm's name and bound by the acts of other partners. Please remember, subject to the provisions of the partnership deed. Mr. Shiv, we are discussing the Indian Partnership Act 1932. We will be discussing LLP in the evening today at 9:30. So right now the questions on LLP can be parked. We will discuss it later. If you have any questions on Indian Partnership Act 1932, I will be happy to answer it. Okay. The true test of partnership is the existence of mutual agency. That means when a partner does any act in good faith on behalf of all the other partners and the firm, he binds the other partners and the firm by his actions, be it liability or a asset. So that is one of the true tests of partnership. Another important point is sharing of profit is an essential element in partnership, but it is not a conclusive proof of partnership. Now, if you look at the partnership deed, it definitely speaks about the profit sharing ratio of the partners, but that is not conclusive evidence that the people are running a partnership firm. The first point is important, where one person can bind the other person by his actions. That is a conclusive test of partnership. Sharing of profit is a prima facie evidence. Thus, partnership can be presumed when there is an agreement to share the profits of the business and the business is carried on by all or any of them acting for all. So like I said earlier, one partner can carry on the business on behalf of everyone, or all the partners can carry on the business of the firm. This is subject to the provisions of the partnership deed. So whatever is mentioned in the partnership deed has to be followed, because partnership deed is a document where the terms of which have been agreed upon and compiled by all the partners together. Types of partners. Hello Aditya, hello Ketan, how are you? Okay, types of partners. We have five types of partners present in a partnership firm: sleeping partner, endowment partner, nominal partner, partner in profits only, working partner, partner by holding out. Now, what is a sleeping partner or dormant partner? Sleeping partner or dormant partner, like the name says, is a partner who is dormant. He does not take part in the day-to-day running of the partnership firm, but only invests his capital and takes a share in the profit. He is not eligible for remuneration as well. He only oversees and is a part of the and invests the capital in the partnership firm. He does not work in the partnership firm or put in efforts in running the day-to-day affairs of the firm. The nominal partner is someone else who just lends his name to the partnership firm. He need not contribute capital, need not get a share in the profit or loss, but he lends his name to the partnership firm in order to increase its visibility or increase its value. A partner in profits only is a person like a minor who cannot be a partner, but he is a partner only in the profits of the firm. In case the partnership firm makes a profit, then he gets his share. If the firm does not make a profit, he does not get his share. A working partner, like the name says, is a normal partner who works and takes care of the day-to-day affairs of the partnership firm. And he is also eligible to a remuneration. So a working partner is a person who takes care of the business, runs the business. Unless until specified by the partnership deed, all the partners of a partnership firm are working partners and are eligible to work for the common goal of the partnership firm. Partner by holding out. Partner by holding out is a person simply who projects an image to the external world by his actions that he's a partner in the firm, but in actual situation he may not be so. He might just lend his image to the partnership firm. So he does not contribute capital, he does not get a share in the profit or loss, but he only projects himself to be a partner of the firm, whereas in reality he is not. Okay, now let's quickly look at what each of the partners means. Sleeping partner. They share profits and losses and are liable to third parties for all acts of the firm. They are, however, not required to give public notice or are on the retirement from the firm. So one important point to be added to my earlier discussion is sleeping partner need not give a public notice. Any normal partner who leaves the firm due to retirement or any reasons has to give a public notice to the public in one regional language and one English language newspaper that he has left his partnership firm, and he shall not be responsible or liable for any acts of the firm done after he has retired from the firm. If he does not give this notice, then he shall continue to be liable for the acts of the firm even after his retirement. A nominal partner, a person who lends his name to the firm without having any real interest in it, is called a nominal partner. He is not entitled to share the profits of the firm. Neither he invests in the firm nor takes part in the conduct of the business. He, however, is liable to third parties for all acts of the firm. Please remember, if someone just lends his name to the partnership firm and based on or relying upon his name, if a person enters into a transaction with the partnership firm and incurs a loss, then this person who is a partner, a nominal partner, is liable to the third person for the losses he has incurred relying on him. Partner in profits only, a person who is entitled to share the profits only without being liable for the losses, is known as a partner for profits only, and also liable to third parties for all acts done of the profits only. Partner by holding out. Partnership by holding out is also known as partnership by estoppel, where a man holds himself out as a partner or allows others to do so. He is then stopped from denying his character he assumed and upon faith on which creditors may have assumed. Like I said, if someone openly comes out, a celebrity openly comes out in the public and says, yes, Shiv, I'll answer your question. If someone openly comes out in the public and says, yes, I am a partner in this particular firm and I know the people and their product and it is very good, in that case, he is a partner by holding out. In the end, if there is any liability that occurs to any third person, he then cannot say that, no, I'm not a partner. I'm just a partner by holding out. He will be liable. Now, coming to Shiv's question, Shiv, what is the reason for including partner who shares the profits only? See, at times, you need to have, maybe the partner has a certain expertise. Okay? Maybe the partner has certain expertise and you require his expertise. And please remember, at that point in time, you require him more than he requires you. So you are a partner of a firm and you go and tell him that please come and become a partner in my firm. And in return for that, if the firm makes profit, I will give you a profit. Obviously, he will ask you a question, what about losses? Then he tells you, no, sir. If there are any losses, you will not have to come, but if there are only profits, you come. So that's an incentive for that expert or seasoned person to join the firm as a partner or in profits only. Hi Ketan, so who is an ostensible partner? Ostensible partner is also a partner by similar to what it is holding out, who projects himself to be a partner in the firm even though he is not. Okay, now quickly we go through what are the kinds of partnership. On the basis of duration, we have partnership at will and partnership for a fixed period. Please remember, a partnership deed is a document that governs all the laws, rules, and regulations of the partners and the partnership firm. So, if a partnership firm is made at will, that means there is no particular time period or period for which it is being framed. It is the partnership firm continues till the will of the partners. If and when in future the partners decide to shut down or dissolve the firm, they can give a notice and dissolve the firm. But until they do so, the firm continues to function. So that is a partnership at will. What is a partnership for a fixed period? In case the partnership firm right at the beginning was started only for a fixed period, maybe 6 months, 1 year, 2 years, 10 years, 5 years, and once that period of maybe 5 years, 10 years, 2 years is over, in that case, the partnership firm will cease to exist after the expiry of the period. Okay, on the basis of extent of the business, general partnership and particular partnership. If the partnership firm is created for a general business or for business in general, then it is called as a general partnership. And the partnership deed contains the clauses for the various businesses that the partnership firm can conduct. So please remember, a partnership firm can conduct only those businesses that are entered into the partnership deed. So a partnership deed normally carries a lot of business, whether they're related or unrelated, and the partners and the partnership firm can carry on all those businesses. But if a partnership deed or a partnership firm is created to just carry on one particular business or for a particular purpose only, then that partnership firm has to carry on that particular business or activity only. It cannot carry any other activity, and once that activity is over, the partnership firm ceases to exist. So these are the kinds of partnership firm listing. So let's quickly have a run through as to what are the kinds of partnership. Partnership at will. According to section 7 of the Act, it is a partnership when no fixed period has been agreed upon for the duration of the partnership and there is no provision made as to determination of the partnership. Like I explained, partnership for a fixed period, when a provision is made by the contract for a duration of the partnership is called partnership for a fixed period. Particular partnership. A partnership may be organized for a prosecution of a single adventure as well as a conduct of a continuous business. So in that case, it will be known as a particular partnership. Where a partnership is constituted with respect to the business in general, it is called general partnership. I have explained these points. In case there is any questions, please feel free to ask. If not, we will proceed. Now, let's go to the rights of the partner. Take part in the conduct of the business unless until otherwise contained in the partnership deed. Every partner is authorized to take part in the conduct of the business, to share equally in the profits of the business. Until otherwise mentioned in the partnership deed, each partner will share the profits and losses of the firm equally, to access to and inspect and copy from the books of the firm, to be the joint owner of the firm. Every partner will be the joint owner of the firm. Similarly, if he is the joint owner of the assets of the firm, he is also jointly liable for the liabilities of the firm. In emergency, take actions to safeguard the firm, to resist introduction or admission of a new partner. Please remember, a new partner can be introduced into a partnership firm only with the consent of all the other partners. If it does not happen, no new partner can be admitted into the partnership firm. Right not to be expelled. What do you mean by expelled? Expelled means to be thrown out. So no partner can be thrown out of the partnership firm without a valid reason. The valid reason could be gross negligence, misconduct, or unlawful or illegal activities. Even then, there is a procedure set up in the partnership firm. Yes, Shiv. Sir, if particular partners ended particular partnership, but they want to continue partnership, then what kind of partnership? Okay. So if I understand your question right, A, B, C, D carry on a partnership firm. They carried on business A, B, C, D and Co. for 5 years, then they shut it down, and then they want to continue partnership, then what kind of partnership? Is that your question? Shiv, can you reply? Okay, in that case again, if ABCD and Co was a partnership firm, then my first question is, why did they end the partnership if they want to come back into partnership again? Okay, anyway, for some reason, if they ended the partnership A, B, C, D, and Co, and now they want to come back as partnership, they have a choice of either starting a normal partnership firm under the Indian Partnership Act 1932, or start an LLP, that is a limited liability partnership, under the Limited Liability Partnership Act 2008. Now, the provisions of Indian Partnership Act 1932 is being discussed here, but the provisions of Limited Liability Partnership 2008 will be discussed at 9:30 p.m. today. So I request you to be part of that session as well. Shiv, I hope I answered your question. Okay. Now, what are the duties of the partner? General duties: to carry on the business of the firm, to be just and faithful, to give true accounts and complete information, to indemnify the firm for the loss caused by him during the conduct of the firm's business. Please remember, like I told you earlier, the firm and the partners are bound by the action of another partner. So in case due to the action of one partner, the other partners incur a loss, then the partner due to which the loss incurred is responsible to indemnify them of the loss that happened, to contribute to the losses of the firm in equal proportion. The profit sharing and the loss sharing ratios of all the partners is mentioned in the partnership deed and needs to be adhered to strictly. Not to assign his own share to some other party. Like I said, his own share cannot be assigned to some other party without the unanimous consent of all the other partners. To attend to his duties diligently. Every partner is supposed to attend to his duties diligently. Yes, Shiv. Like ABC sell mask, but after some time there is no need of this partnership and they want to continue partnership for other business. Then which kind of partnership is this? Okay, in that case, okay, then that's no. It's neither a partnership at will nor a general. See, please remember. Hi Mahesh. Hi Michelle. Welcome to my session. Hi Barkha. Okay, Shiv, to answer your question. Now, let's say ABC are three partners of a firm, and they start a firm to sell masks. Please remember, sell mask is not a particular activity. When I said particular activity, it means if ABC have come together to form a partnership firm just for construction of a building. So once the building is done or it's completed, then that partnership firm ceases to exist. But is there an end or a completion date for selling masks? Can you say, okay, I've started this partnership firm ABC to sell 100 masks, and once I sell 100 masks, I will close the business? So I don't think so. That is the objective. So in case the partnership firm was started to sell masks in the beginning, but after some time there is no need to you do not want to sell masks but want to continue partnership for some other business, then all you can do is change your partnership deed, amend your partnership deed to include the business that you want to do, and you can continue carrying on partnership business with ABC. So I repeat, there is no need to end this partnership because selling mask is not a particular target, right? So you can amend your partnership deed, include the new business that you want to do in this, and then continue to run the business. Then again, it will be a partnership at will as well as a general partnership. I hope I answered your question, Shiv. Okay. Now, liabilities of a partner. General liabilities arise when he fails to be just and faithful to the other partners. He fails to carry on the business of the firm in highest common interest. He fails to give true accounts to indemnify. So please remember, if any of the partner works in a dishonest manner or due to his actions, any of the other partners are liable to have any losses, then it is the liability of the partner due to whose negligence or misconduct the other partners have faced a loss to reimburse or indemnify them. So also, if he fails to carry out his operations diligently, fails to give his accounts to the other partners of the firm diligently, then he will be liable to the partners and the firm. Now let's come to today's topic, reconstitution of a firm. What do we mean by reconstitution of a firm? Hi, Swajal. Okay. Modes of reconstitution under the Indian law are Admission of a new partner, retirement of a new partner, expulsion of a partner, death of a partner, insolvency of a partner. Now, if you closely look, hi, good evening, Srijal. Hi. Admission of a new partner. Now, what happens? Let's say A, B, and C are carrying on a business, carrying on a partnership firm, and suddenly they decide to get D into the partnership firm. So, is it an admission? Yes, it's an admission because D seems to be a new partner. Now, what is the so far whatever we've discussed? What does the provision relating to admission say? That firstly, all the partners, that is A, B, and C, need to be ready and give the unanimous consent for admission of D as a partner. Point number one. Point number two, D should be eligible or should have the capacity to contract. That means he should not be a minor, he should not be a person of unsound mind, or he should not be a convict, or he should not be expressly declared as a person disqualified to enter into contracts for him to become a partner. So if this condition is fulfilled, firstly, then D can be taken into the partnership. Now, what happens if D is taken in as a partner of the firm? Now, please remember, if A, B, and C were sharing the profits and losses in the ratio 33, 33, 34, that makes it 100%. I think so. Yes, 100%. Yes. Now, if D is taken in as a partner in the firm, now do you think the profit sharing ratio of A, B, and C is going to increase, or the profit sharing of A, B, and C is going to decrease? I think it's going to decrease. So instead of 33, 33, 34, it may become 24, 24, sorry, 25, 25, 25, 25. That makes it 100%. Yes. So if A's earlier profit sharing ratio was 33, which became 25, how much has he lost? He has lost 8%. So that 8% is known as sacrificing ratio. Similarly, B's old profit sharing ratio was 33% and the new profit sharing ratio became 25%. So how much has he lost? 8%. Similarly, C's profit sharing ratio earlier was 34% and the new profit sharing ratio is 25%. So how much has he lost? 9%. So this 8, and 9%, what A, B, and C have lost respectively, is called the sacrifice ratio of existing partners. And how much has D gained? D has gained 25%. So that is his new profit sharing ratio. So please remember, when a new partner is admitted, again, the terms and conditions between the partners have to change. The new partner might be required to contribute to the capital and goodwill of the firm. And once he contributes, then his profit sharing ratio is determined. A new partner is not liable for any act of the partnership firm done before his retirement, before his admission. Let's say a partnership firm was carrying on business till June 30th, 2019. On 1st July, they admitted D as a partner. So please remember, for all the acts, whether right or wrong, of the firm till June 30th, 2019, D will not be held responsible, but D's responsibility will start only from 1st July onwards, since the time he became a partner. Am I clear? We will talk about each point in detail. I'm just giving you an idea about what's happening. A retirement of a partner. What do you mean by retirement of a partner? A, B, C, D were partners in a firm, and D, due to ill health and old age, finally decided to take rest, and he said, okay, I'm retiring from the firm. So earlier the profit sharing ratio between all the partners was 25, 25, 25, 25, and D decided to retire. So when D decided to retire, the profit sharing ratio of D will be distributed between A, B, and C in their respective ratios. So similar or opposite to what happened in admission of a partner, wherein there was a sacrifice ratio, in retirement of a partner, there is something called as a gain ratio. Due to the retirement of D, A, B, and C gained something in their profit sharing ratios. So that is known as gain ratio. Yes, Shiv? A public notice is not given by a partner at the time of retirement. Did he or she liable for the activities after his retirement? I'm just coming to that point. That's a good question. Now, once a partner has retired from the firm, it is his duty to give a public notice, that is in one regional paper and one English paper, that he has retired from as a partner from the partnership firm effective so and so date. Once he gives the notice, then he is not responsible for any acts of the firm done post his retirement. Now let's take the previous example again. A, B, C, and D are partners and they carry on business till June 30th. On July 1st, D retires from the partnership firm. And on July 2nd, he gives a public notice saying that he has retired from A, B, C, D, and Co. And due to so and so reason and effective so and so date, effective 1st July. Once he gives this public notice, he is not liable for any wrong acts of the partnership firm done after his public notice or retirement. Shiv, I hope I answered your question. Hi Disha, welcome to the session. Shiv, have I answered your question? But in case of sleeping or dormant partner, is not necessary. Yes, like the law says, in case of sleeping or dormant partner, it is not necessary, obviously, because the sleeping partner was anyway not involved in the day-to-day affairs of the company, so he cannot be held liable for the actions of the company. If a person is involved in the day-to-day activities of the company, only then can he be held responsible. But if your partnership deed itself is calling a sleeping partner or dormant partner, it is understood that he is not involved in the day-to-day functioning of the partnership firm. So the partners who are responsible for the day-to-day functioning of the partnership firm alone will be held responsible. Does that answer your question, Shiv? Thank you. Expulsion of a partner. Now, due to any reason such as misconduct or gross negligence or illegal or unlawful activities, in such a case, the partners can get together and they can remove a partner from the partnership firm as per the provisions of the partnership deed. In case the partnership deed is silent about it, then they might have to take legal course to expel a partner from the partnership firm. Coming back to retirement, I forgot to mention one point. Once a partner retires from a partnership firm, then he is also eligible to get his capital, whatever is there in the firm, the profits made by the firm until the day he retires, and get a copy of the accounts, which we will discuss further. Hi Suyash, welcome. Death of a partner. Now, death of a partner is also similar to retirement of a partner, wherein a person leaves the partnership firm due to his death. Once a person dies, his capital, his profits, and other things are to be given to his legal heirs or legal representatives who can come and claim it. Hi Suyash, good evening. Insolvency of a partner. If any of the partners of a partnership firm is declared insolvent by a competent court, in that case they have to leave the firm. They cannot continue the partnership firm simply because their capacity to contract is compromised. Yes, Shiv, what's your question? Can you please pardon expulsion of partner? What's the question, Shiv? I'm sorry, I did not understand the question. Okay. Admission of a partner. Only with prior consent of all the partners as per contract. New partner not liable for any act done before his or her admission. Minor cannot be admitted as a partner but get admitted to the benefits of the partnership. Results in change of profit sharing ratio. I have already discussed these points with you in terms of for an admission of a new partner. Retirement of a partner due to poor health, personal reasons. Yes, Shiv, I will repeat expulsion of a partner. Due to poor health, personal reasons, etc., a partner may have to retire from the partnership firm. As per terms of the agreement, results in change of the profit sharing ratio, which is a gain ratio, which I explained to you. Liable for acts of the firm done before his retirement, not liable for acts done after his retirement if public notice is given. I have explained these points in detail to you as well. Take about 20 seconds, go through the slide, and please ask me if you have any question. Okay, Shiv, coming to your question, please repeat expulsion of a partner. Expulsion of a partner simply means throwing out a partner or removing a partner from a partnership firm. Now, why would a partner be removed? A partner could be removed because of his gross negligence, misconduct, or if he carries on any unlawful or illegal activities, then the other partners can get together and remove the partner from the firm as per the provisions of the partnership deed. If the partnership deed is silent about it, then they have to take legal recourse in order to expel or remove him from the partnership firm. The treatment of accounts and treatment of everything else will be similar to retirement and death of a partner. And also, he shall not be liable for any acts of the firm after his expulsion. But if he has carried on any negligent or misconducting activity, he will be responsible and liable for that to the other partners. I hope I answered your question, Shiv. Hi Sanjeev, hi Vaishnavi. Hi Prem, welcome to my session. Let's proceed. Expulsion of a partner due to misconduct, breach, etc., done in firm's interest, approved by majority partners as per the agreement. Like I told you earlier, all the partners decide and they decide to throw him out or put him out of the partnership firm. That is the expulsion of a partner. Death of a partner. A death of a partner will result in dissolution of the partnership firm unless there is existing contract between remaining partners for continuation. Legal heirs of deceased partner have the right to share of profit of the deceased. Deceased estate not liable for any acts after his demise. Let's say A, B, C, D are partners of the firm and D passes away. So the remaining partners A, B, and C have to form a new partnership and continue the partnership business, because the death of any partner results in dissolution of the partnership firm automatically. And once the partner dies, his estate or his legal heirs are authorized to collect his belongings or his balance from the partnership firm, if any. Deceased estate is not liable for any acts after his demise. Similar to retirement, if after the demise the estate or the property of the deceased is not responsible for any acts of the partnership firm or the partners, it is only up to his demise that can be adjusted against his estate. Insolvency of a partner declared as insolvent by competent court, again he will be removed from the partnership firm. Any questions, please ask me. Hi Shravani, hi Sanidhya. Okay, now reconstitution has happened. Now there has been an admission, or there has been a retirement, or there has been a death, or there has been a partner who's expelled, or there is a partner who was declared as insolvent by a competent court. What happens then? Then there is a change in mutual rights and duties. So please remember, when a new partner is added or a partner is driven out of the partnership firm, there is a change or a shuffle in the mutual rights and duties of those partners. A lot of the outgoing partners might have been carrying out a lot of roles and responsibilities and duties, which now will have to be carried on by the existing or continuing partners. So there will be a reworking on all the duties and rights, mutual rights of all the partners. Please remember, there has to be a notice to the registrar. In case it is a registered partnership firm, then the notice to the registrar has to go within maybe 30 days or 60 days of the reconstitution of the firm, that so and so change has happened in the partnership firm, and so changes need to be recorded by them in the register of firms. Revocation of continuing guarantee. Now, what do you mean by this term? I would request you to listen to me carefully. Now, let's say A, B, C, and D were partners in a firm, and that firm had taken a loan from a banking institution or a financial institution and given a guarantee, a joint guarantee, in order to take the loan, a personal guarantee. Now suddenly D retired or D dies, so there is a reconstitution of the firm. So now once a reconstitution happens, wherein one partner is admitted or one partner leaves the firm, the existing guarantees, or as on the date of the event, will lapse, and they will actually have to go back to the banking financial institution and tell them that so and so partner was there, now he has left, and they will also have to take the permission of the bank, because the bank has given them a loan based on the personal guarantee of the partners. So whenever there is a reconstitution of partnership, the same will result in the revocation of continuing guarantee of the firm. And similarly, if the firm has received any guarantees from anyone, that will also revoke and the new guarantees will have to be taken. Now, this is the last topic under this chapter, the Indian Partnership Act. Now, what do you mean by registration of firms? Shiv, the next class is today at 9:30 p.m. and we will be discussing Limited Liability Partnership Act 2008, which is a step ahead of Indian Partnership Act 1932. Okay. Now, what do you mean by registration of firms? Now, see, a partnership firm registered under the Indian Partnership Act 1932 need not be registered. You can just prepare a partnership deed outlining all the roles and responsibility, duties, and regulations of the partnership firm and start off the business. Using that partnership deed, you can get your various registrations, your GST registration, your MSME registration, and all the registrations under the various laws. But it is not mandatory for you to get registered, to register your firm with the registrar of firms. That is an optional thing that you need to do in case you want to do. So now in this topic, we will talk about the benefits and the disadvantages of registering or non-registering your firm with the registrar of firms. Please remember, it's completely optional. There is no mandate that makes you register your firm with the registrar of firms. The registration of firm may be effected at any time by sending a statement in the prescribed form and accompanied by the prescribed fee stating the firm's name, the place or the principal place of business of the firm, the names of any other places where the firm carries on business, the date when each partner joined the firm, the names, the full permanent addresses of the partners, the duration of the firm. The statement shall be signed by all the partners or by their agents specially authorized on this behalf. Okay, now firstly, whenever the partners decide to register their firm with the registrar of firms, we will discuss the advantages of registering in the next slide. Then they have to send to the registrar of the area in which the registered office of the partnership firm is situated, or the sub-registrar of firms. He's called a registrar or sub-registrar of firms in the area in which the partnership firm is located. A statement containing details such as the name of the firm, the principal place of business, the other places of business where they carry on businesses, the complete name and addresses of all the partners, their profit sharing ratio, the date on which they became partners, and the duration of the firm. Please remember, like I said, a partnership at will. If it is a partnership at will, there has to be a clause in the partnership deed saying this partnership is at will. So that makes it a partnership at will, that until and unless the partners decide to shut it down, it will continue. So all the partners sign this statement and send it to the sub-registrar of firms or registrar of firms of the local area in which the registered office of the partnership firm is situated. Each person signing the statement shall also verify it in the manner prescribed. By this, we simply mean there are certain clauses that says that me, the partner of so and so, have clearly read and understood the terms and conditions, and also declare that whatever is stated above is true to my knowledge. And if any information is proved to be false, I will be liable for the same. So every partner needs to verify a declaration like this. A firm shall not contain any of the following words, namely crown, emperor, empress, empire, imperial, king, queen, royal, or words expressing or implying the sanction, approval, or patronage of the government. Please remember, you can have any name of your firm. You can have ABC Enterprises, ABC Co. You can have your name. Let's say, for example, Deep has just joined the session. You can have a partnership firm called Deep and Company or Deep Enterprises, whatever name you want, but you cannot use the terms as crown, emperor, empire, empress, imperial, king, queen, royal, or any words which show that you have the government backing or undertaking with you. So the names can be anything, but you cannot have a name which gives a false impression about your firm. Any questions, please ask me. Okay, the registration of firm is optional. Like I said earlier, there is no mandate which forces you to get your firm registered under with the registrar of firms or sub-registrar of firms. It is completely optional and it's left up to you if you want to do it or not. If you want to do it, the procedure was that you need to send a statement along with the prescribed fee. The fee will depend on the capital of the partnership firm. The higher the capital of the partnership firm, the higher the fee. Now, the registration. When the registrar is satisfied that the provisions of Section 58, above mentioned provisions, have been duly complied with, he shall record an entity in the entry of the statement in the register called the Registrar of Firms, and shall file the statement and issue a certificate of registration. So the registrar, once you file a statement to him, he will scrutinize the statement, he will see if the fees is paid, and if there is anything wrong with the statement, he will send back that statement to the partners and tell them to redo it or make the correction. Once that is done, then in that case, if he is satisfied that all the formalities have been completed, he will enter the name of the firm in a register called the Registrar of Firms and issue a certificate of registration to the partnership firm. That registration certificate will have to be displayed by the partnership firm in their place of business. So then that completes the registration process. It's not a very complicated process, but yes, it's completed the process. Any questions? Please ask me. Okay, now consequences. Now, like I said, registration of a firm is not mandatory. It's optional, but what happens to a firm, a partnership firm, in case it is not registered? So the consequences of non-registration, Section 69. Non-registration of partnership gives rise to a number of disabilities. Although registration of firms is not compulsory, yet the consequences or disabilities of non-registrations have a persuasive pressure for their registration. These disabilities briefly are as follows. Please remember, now all of us, when we download an app from our Play Store, there are a lot of apps which initially gives us a lot of terms and conditions written in fine print, and when we scroll down, there is a button saying agree and accept, right? So maybe we don't read it. Maybe most of us do not find the time to read it. When we get an insurance policy for ourselves, be it medical or life insurance policy, or when we buy something, please remember, there is always certain terms and conditions mentioned in fine print over there. Most of us, we just go down and we say sign and agree, and we sign it and give it off when we get the insurance policy or the product or whatever it is. Things are okay as long as they are going fine, but please remember, when unfortunately if someday things go wrong, someday if you have an insurance claim, or someday if something happens, that is where those fine print wordings come into existence. Okay, that is where the topic comes into existence. So as long as things are going well, it's okay. See, that same thing happens to a piece of agreement. Let it be whatever agreement, when two friends come together and they start business. So at that point, the agreement is just a piece of paper. But unfortunately, if things go wrong between the two friends in terms of money, in terms of business, in terms of negligence, that is where that piece of paper comes into place, where people go looking for that piece of paper immediately, and then they start scrutinizing each and every clause contained in the agreement, and then they take legal remedies based on that piece of document. Similarly comes the consequences of non-registration. If things are going well, no one will even think about registering his partnership firm. It is only when unfortunately things go a little out of hand, or things go bad, or start to go bad, when people think about registration of a partnership firm. So let's talk about the consequences of non-registration. No suit in a civil court by a firm or other co-partners against third party. Let's say you gave you sold, the partnership firm carries on the business of furniture. It sold furniture to an outside party, to a customer, and the customer did not pay you. He's run away with the furniture and he does not pay you. Please remember, if you are not registered, you cannot file a case against the third party. So for that reason, you have to get yourself registered first, and then you can file a case against the third party. The firm or any other person on its behalf cannot bring an action against the third party for breach of contract entered into by the firm. Simple. So as long as things are going well, no one cares. But once the third party or your customer has run away with the goods, that is where you realize that you cannot file a case against him until you get your firm registered. So there is no time limit. It's not necessary that you need to register your firm the minute you start it. You can register it in future at any time when you feel the need to do so. No relief to partners for set-off claim. If an action is brought against the firm by a third party, then neither of the firm nor the partner can claim any set-off. If the suit to be valued of more than 100 rupees or more, proceedings to enforce the right against any contract. So if any third party actually files a case against any of the partners, then the partners cannot claim a relief until and unless the firm is registered. So you see, the firm cannot file a case against the third party can file a case against the firm, but then the partners need to get the firm registered in order to proceed with the case. Aggrieved partner cannot bring legal action against other partners of the firm. A partner of an unregistered firm is precluded from bringing legal action against the firm or any other person alleged to be or have been a partner in the firm, but such a person may sue for dissolution of the firm or for accounts. Now, similarly, A, B, C, and D are partners in the firm. Now, there is a disagreement that has crept in between A, B, C, and D. Now, A, B, C, and D cannot file a case against each other or the firm A, B, C, D, and Co. until and unless the firm is registered. All A can do is A can apply for dissolution of the firm in case there is embezzlement or negligence in the conduct of the business of the firm, but he cannot file a case against any other person who has or is being the partner of the firm until and unless the firm is registered with the registrar of firms. Third party can sue the firm. Like I said earlier, the firm and the partners cannot sue the firm, cannot sue an outsider, but an outsider can sue an unregistered firm. And in order to go ahead with that case, the firm will have to get, unregistered firm will have to get registered with the registrar of firms. I hope I'm clear. So far, any questions, please ask me. Yes, Shiv, what's your question? So please explain the topic relation of partners to third party. Okay. See, now the topic, quickly I will answer your question. The topic relation of partners to third party. Now, as I said in the beginning, a partner can bind all the partners or the firm by his actions unless otherwise provided in the partnership deed. So when any of the partner is dealing with a third party, please remember he is dealing like an agent of the partnership firm, and he is binding the partnership firm by his actions with the third party. So it becomes very important for the partner to act in a very transparent and diligent manner and to take up his duties most responsibly with the third parties. He cannot cheat or he cannot mislead the third parties on behalf of the partnership firm. Okay, dissolution of firms. According to Section 39 of the Indian Partnership Act, the dissolution of partnership between all the partners of the firm is called dissolution of firm. The dissolution of partnership firm may be in any of the following ways. Dissolution without the order of the court. Please remember there are two ways of dissolving a partnership firm. One is without the order of the court and one is with the order of the court. So let's look at each of them. Dissolution by agreement. It simply means when all the partners suddenly feel that, okay, the business is done or we no longer can work together. By agreement, they decide to dissolve the partnership firm. So that is called dissolution by agreement. Compulsory dissolution. Compulsory dissolution is when by an action or either by an application made by one of the partners, it is turned out that the business of the firm is unlawful, illegal, and there is misconduct or gross negligence, then the court can decide for compulsory dissolution of the firm. Dissolution, or if it is a partnership for a particular purpose or for a particular duration, in that case, after the purpose or the duration is completed, the firm can be compulsorily dissolved. Dissolution on the happening of uncertain events or contingencies. For example, if there is a death of one or more of the partners, then the firm stands dissolved. That is an unfortunate event. Dissolution by notice in partnership at will. All the partners are okay, the business is going well, but then suddenly the partners mutually decide that let's end this partnership. So then they give a notice to each other and they end the partnership at will. Let's quickly run through what it means. Dissolution by agreement. A firm may be dissolved with the consent of all the partners or in accordance with the contract with the partners. Compulsory dissolution. A firm is compulsorily dissolved by the happening of any event which makes it unlawful for the business of the firm to be carried on or for the partners to carry on its partnership. Dissolution on the happening of certain contingencies. Subject to contract between the parties, a firm can be dissolved on the happening of any of the following contingency, like expiry of the fixed term, completion of adventure, death of a partner, or insolvency of a partner. So if any of these events happen, then the firm can be dissolved due to certain contingencies. Dissolution by notice of partnership at will. Where the partnership is at will, the firm may be dissolved by any partner giving notice in writing to all the partners of his intention to dissolve the firm. So these are 4 ways in which partnership firm can be dissolved without the intervention of the court. Now, let's look at dissolution by the court. In the following 7 instances, there can be dissolution of a partnership firm by the court. The insanity or unsound mind of any of the partners. If on the application of any partner or the court comes to the view that a partner is insane or of unsound mind, it can immediately order for the dissolution of the firm. If any of the partner is permanently incapable of performing his duties due to an accident or due to old age or due to any reason whatsoever, then an application can be made in the court for it to be dissolved. If there is any misconduct of one or more partners in the firm, misconduct means embezzlement, theft, or any other fraudulent activities, then the other partners can apply to the court for them to dissolve the firm compulsorily. Persistent breach of agreement. If now, as I said, a partnership deed is the agreement that determines the partnership firm. If there is a consistent breach of the terms of the agreement by one or more partners, the remaining partners can apply to the court and ask the court to compulsorily dissolve the partnership firm. If there is a transfer of interest, A, B, and C are 33% share holders in the partnership firm. C, without the consent of A and B, transfers his 33% profit share to D. This event can lead to the compulsory dissolution of the firm by the court in case A and B go to the court and apply for the same. Continuous or perpetual losses. A partnership firm is going on making losses year on year. In such cases, the partners or the sundry creditors, in case they are unpaid, can apply to the court for the dissolution of the partnership firm. Just and equitable grounds. If there are any other just and equitable grounds based on which the partnership firm can be dissolved, then the court will order the partnership firm to be dissolved. The consequences of dissolution. Consequent to the dissolution of a partnership firm, the partners have certain rights and liabilities. Liability for acts of partners done after dissolution. Partners personally liable until public notice is given. There again, once a partnership firm is dissolved, all the partners need to give a public notice that A, B, C, D, and Co. partnership firm stands dissolved from so and so date, and anyone dealing with a company or firm after so and so date does it at his own risk, and they are not responsible for the loss. In case such a notice is not given, then the firm and the partners will continue to be liable for the losses incurred after its dissolution. The rights of partners to have business wound up after dissolution. Now, please remember, as on the date of dissolution, there might be certain contracts or certain assignments that are incomplete. So, the partners would have taken some advance from the customers or some payments from customers for which the work is not done yet. So, in that case, it becomes their duty to finish all the unfinished business and then do the winding up process. So, that is one of the right of the partners. Continuing authority of partners for purpose of winding up. Again, once a partnership firm is wound up, please remember there is a settlement process that happens. All its assets and assets are sold off, and all the liabilities and outside liabilities are paid off. And after that, if anything is left, that is distributed between their partners. So, for carrying on this activity of selling off the assets and settling the liabilities, the continuing authority of partners is alive even after dissolution until and unless the selling of the assets and paying off the liabilities is completed. Settlement of partnership accounts. Yes, when the partnership firm is dissolved, all the partners need to drop their accounts and pay to the firm if anything is owed by them, and take from the firm if anything is owed to them by the partnership firm. Payment from firm debts of separate debts. Again, like I said, accounts are drawn up, whereas assets are all sold off, the money is collected, and with that money, all the outside liability and firm's debts are paid off. So, and who is responsible to do this? The partners are responsible to do this at the time of dissolution. So, with that, I end the Indian Partnership Act 1932 Part 2. So, I have completed the entire structure. Thank you for being a lovely audience. And please do not forget to use my code Prathik when you make an Unacademy subscription. Yes, Shiv, you have a question. No, I have explained that topic, Shiv. I think you missed it. One topic is remaining minors admitted to the benefits of partnership. It simply means that a minor cannot be admitted as a partner in a partnership firm, but he can definitely be admitted into the benefits of the partnership, which means in case the partnership makes profit, you can give a share of the profits to the minor. But in case it makes a loss, a minor will not be responsible. At the same time, a minor cannot be a partner in the partnership firm because he's incompetent to contract unless he turns 18 years of age. Now, let's say you have made a minor partner in the benefits of the firm, and he turns 18. Once he turns 18, he is given a choice whether he wants to continue in the firm as a partner or not. In case he wants to continue, then yes, you can ask him for his capital, profit and loss sharing and everything. But in case he says no, he does not want to become a partner in the firm, it's over. You cannot do anything more than that. So Shiv, I hope I answered your question. So with that, I end the Indian Partnership Act 1932. Thank you so much for being a lovely audience, and I will see you around. Thank you. My next session starts at 9:30 p.m. today. Thank you and see you all there.